Hi guys, this is Simon with Trade and Perform Coaching, doing the trade review for Friday, the 24th of October. Man, the month is slipping by. It was a really, really, really crazy day. I think that I think it was a difficult day, and I think a lot of what made it difficult was the price action that we had at the end of the day on Friday, the price action from the overnight due to the Ebola situation that we had with the doctor in New York, and then how we traded. So there's two things to look at. First of all, this entire so let's get into it, and let's remember a couple things. So what are my objectives with the zones? Okay, let me kind of build because I always forget the difference between people who are in my room every day and people who are watching the videos to learn. So the objective from the zones is really quite simple. Okay, if we take a naked zone, for example, I can just demonstrate it right here. We rotate down. First time into a zone, I look to buy, get at least a 2 point rotation higher, take my scale, and then exit. I have my stop pre-planned. Okay, that stop is 2 points behind the back of the zone, and I have my exits pre-planned. Now, some people ask me, well, wait a minute, Simon, even if you could have gotten filled, and it would have been difficult to get filled from 1939, why do I have my first scale 2 points above, right? Especially right now when you look at the market, and it's so wide ranging, right? I can get 10 or 20 points. Okay, well, there's a couple of reasons. First of all, the average rotation of the S&P 500 ES is 4.25 to 4.75, depending on the time of the year. Sometimes in the summertime it can be a little bit smaller. Sometimes it can be a little bit bigger, but usually it's 4.25 to 4.75. So by targeting 2 points and by knowing that I have an edge, by specifically targeting the locations that I'm targeting, meaning those zones, there's a purpose and a reason why they're there. And I know that by taking a trade in that location, that I have high odds of getting a counter rotation from that trade. Okay, number two thing that's important, and this comes directly from Mark Douglas's book. I'm a big believer in the methodology that he uses to teach traders, right? Um, Much of the problem in futures trading comes from the use of leverage, okay? In addition, the speed, right, and then of the market, because it trades, and it's something that a lot of people don't understand. The market actually trades differently because it is a leveraged product, even if you're not trading leverage, right? The participants are going to be quicker to react because they're more nervous naturally because they are using leverage and they're using a lot of leverage at that. Okay, so it doesn't matter if you're not using leverage, it's that the gross majority of participants are using that leverage. Okay, so then we go to the third reason, which is the demands and the wants that you place on the market. Most people, particularly those clients who have smaller accounts, and by smaller accounts I mean people who trade with less than $1 million, right, have visions of taking. Look, I've talked to guys with $10,000 accounts. I've talked to guys with $2 million accounts, and they all say the same thing. I want to take it from 10,000 to a million. The guys with a million want to take it to 10 million or 100 million. Okay, the difference is the guy with $1 million account can actually trade for a living. The guy with a $10,000 account, it's going to be very difficult for him to make it through all the psychological barriers to trade consistently, grow that account to the point where he can make money. Can it be done? Yes, but it takes a lot of work, right? But either way, they're still projecting their wants, their hopes, and their needs onto the market. And the only problem with that is the market doesn't give a damn what our hopes, our needs, or our wants are. The market's a machine, okay, and it just does what it does. It doesn't care about you, your position, your level, your stop, any of that. It just goes, okay. The reason why that is important is because the way that we try to contain that, it's an unlimited environment, and traders come in and they try to place limits on that environment. But the problem is you can't enforce those limits on the market. You have to be willing to turn those limits internally and place them upon yourself. So going back to the zone, I know I have an edge at the zone. I know the average rotation is 4.25 to 4.75, and that's been for an extended period of time. So I know that I need, by taking a 2 point target, less than a 50%, right? 50% of what the average rotation is to be able to get out. That means I have a very high win rate. I need a high win rate if I'm going to trade in a leveraged fashion, and I do trade in a very leveraged fashion. That means my wins generally have to stay above 70%. Okay, and initially my risk reward is inverted. I actually have a negative risk reward because the stop is 2 points behind. The only way that my methodology works is if I actually truly have a high win rate, which I do, right? That's assuming I can't put any other filters on it. So let's get back to it. So following Mark Douglas's outline, right? By knowing where my stop is, I have no indecision. I don't turn my hopes, wants, and wishes into forcing me to move my stop up or down. I'm committed to it. And I know exactly what I'll lose, and now I can calculate what my risk is. It should help subdue your fear of wiping out your account. I also have a rule. If I take two back-to-back stops, full stops in a row, I stop trading for the day. Why? What does that keep me from doing? Well, if we have a day that's Armageddon-like, and I get nailed 2 times back to back, I just come back the next day. I've been trading since before 1994. I've been through multiple market crashes, and there's just not been any day that has been like how could I miss that day? There was never another opportunity to go through. Okay, so now I've kind of primed that because it's been a while since I've been doing that. So since I've primed this up. So let's now go back to the market. If I get my entry and I'm trading multiple accounts, and let's say I get this entry here, I scale half at 2, I move my stops up. There's multiple strategies you can use there: net break even, true break even, something in between. You can either scale heavy and leave a smaller trailer, but either way, if you leave a trailer, you now give yourself a chance to get a shot to the upside. Now, as it was, if you'll notice in the live market preview, I had highlighted this particular area, this whole thing. I wanted to stay out of this, and the reason why was the prior day. When you have choppy area like this, it makes this area is very likely to be choppy the following day. I didn't want anything to do with it. Our goals were to trade in this area and stay out of this. So we did almost nothing in here. We couldn't get a fill down here. This was right after econ. The first trade that we took was actually on the first touch of this zone right here. Okay, and this trade I have another rule. I have plenty of rules, but these are rules that keep me safe. I have a 25-minute rule. Again, the focus is on the first touch. And once I exceed 25 minutes, this is 5, 10, 15, 20, 25 minutes in the zone. Okay, I generally either move the stop down to whatever the swing high is, or look to take the trade out either exactly where it's at, or I make the decision that I'll have a smaller stop, but I still try to achieve my target. In this particular case, I shorted right in the middle of the zone at 1955. My target was 1953. It did go to 1953, but it took so long to get there that I ended up only I audibled and took 6 out of the 8 ticks that would have been available. And I did that because, again, we'd exceeded the 25 minutes, and there was almost no sellers to the downside. As you can see, we eventually rolled back and tested the back of the zone. Had I left the trade, my stop would have been 2 points behind my original stop, and it would have eventually rolled into a very nice profitable trade. There are switch offs that I make when I'm trading, and one of the switch offs is that, yes, even though I know I have good location, I also need the time component to work for me due to the amount of leverage that I'm using. So sometimes I have good location and I have a good trade, or what would work out to a good trade, and I just end up missing it. That's the luck component for me, is that I need the snap out of the zone. But here's the deal. If I don't ever draw down significantly, I don't need every zone to work perfectly for me, because the ones that do will more than pay me. Okay, so I hope that makes sense. I know I'm moving a little bit quickly, but from a coaching perspective, well, I'll lose most people's attention after I go past 10 minutes, and I think I've already done that. So if you'll look, all of this got well tested, right? We rotated down. I wasn't here. I'd actually left. This is over just past New York lunch. This is first time into the zone. This is a rotation from 56 down to 47, a 9-point rotation. I had expected a muted trading range. We've gone from 60, and now we've had sub 40 point ranges for the last couple of days now. Okay, and then finally and then the other thing I want to comment was overnight. We'd already trapped from the overnight. Let me see if I have this chart handy here. Is this it? Here we go. So I want to show you from the overnight. This is Dr. New York has Ebola. This is everyone freaks out or may have Ebola. We took these longs at the end of the day to the upside. We did very well here. This is overnight. Dr. has Ebola. Asia panics, right? This is about 8 o'clock in the evening Central Time. Now, I want to show you. I did post out 2 things. First of all, I said if it gets really ugly, we could trade down to, where in the world is my Twitter account? I said if things get really ugly, we could trade down to 1925. They didn't. But then right after that, I said, on the other hand, holding above 1937 would have panic sellers trapped for a move potentially back to 1950. And sure enough, once we trapped back above 1937, you can see they try to push below all night in Europe, unable to do so. What happens here is a lot of people get short. A lot of people were short in here thinking we were going to zero. But you got to remember, it's not just the people who were shorting here are not just future traders. A lot of them are retail traders shorting the spiders. They can't cover, okay, most of them can't cover till we get over here in the morning. So you have all these shorts. You have people in the futures market who piled in all the way through Europe and overnight. And so then we come in, and right before our open, those guys get squeezed when they say we're not moving up. The squeeze ends. We come back to do a backside test of the overnight lows. That's where this zone comes in, and I almost had it nailed perfectly. I didn't get it exactly right, but I should have gone a tick higher. But you know, what are you gonna do? I'm making these zones before the stuff actually happens. So you know, I missed it by a tick. There was almost no way to get filled at 1939. Off we go from 39 all the way up to 60, right? And then if you'll notice, every day when I put out these zones, there's these orange highlighted areas. This was the first area I had as a high potential upside target and reversal location. Okay, so we didn't get up, we didn't quite get up there. We may have gotten it in after hours. This 1959-1960 zone held us into the close, the 315 close, and that's where we left off. But if you'll, the other thing that you'll notice is that I had tweeted out near the end of the day. Okay, and I'll share this with y'all again. And I put in right here. Change the color here. I put out, first I put out the price action makes, now this was, I put this out around, I think 1:30 in the afternoon. I said the price action makes me wonder if some very big players did not get caught trying to short the initial bounce and are now very trapped. And I wasn't talking about the initial bounce from yesterday. I'm talking about the bounce from the lows. You got to realize we've come up from 1813 all the way to 1959. If I were working at a hedge fund, or most hedge funds, they're going to look at it and go, that's a 50 to 60% retrace. Let's start shorting. That would have started you getting short around 1906 to 1920, depending on how you measure, right? Though I think those guys looked and they saw, well, Ebola didn't bring it, you know, the whole Ebola thing, if they didn't cover into that, and the market showed no weakness early in the day on Friday, and you're going into the weekend and you're kind of going, you had Amazon missed numbers, and you're kind of going, well, damn, there may not be a downside. And you add that additional, hey, there's a ton of cash on the sidelines, right? Think about everyone, myself included. I actually liquidated a portion of my IRA when we were up near the highs. And I was thinking about when we were down 10% putting that money back to work, but I got so busy doing all my other stuff that I didn't actually put that money back to work. There's a ton of cash on the sidelines, and they're all going, damn, we just missed a 10% correction. And now, what if we go to new highs, which is not far away? And you've added fuel to the fire by having people short, thinking this is the beginning of the bigger move down and that we've seen the highs for the year. And then also I had tweeted right after that, it's not actionable. And again, not actionable, but the only way to get sellers is via someone coming down with Ebola and NYC, right? If that's the only way we're going to get significant downside, then this has become a very hard environment to short. That's where I stand right now. I am looking primarily for longs. And what that means is not that I won't short. It means that I'm quicker to cover my shorts and I'm more patient with my longs. And that's my stance as of right now. So at any rate, I hope that helped give a little bit of framework to the market we're in. The environment has changed incredibly quickly from where we were in August to September to October to November. And this is what these quick changes and these quick bias changes in the market is exactly what perpetuates the boom bust cycle in day traders. And it's exactly what I'm trying to work between my room and my one-on-one coaching to help alleviate. So all that being said, I welcome anyone into the, I'm completely booked on the coaching. I have absolutely no space, and it looks like no one has any desire to stop the coaching right now. So there is no room on the coaching. I'm taking names of people who are interested in it, and as if someone drops out, I'll allow someone to add back in. The room, anyone's welcome to come join the room for 7 days to see what it is that we do. I usually trade into the live trading session 1 to 2 hours in at least every day. Sometimes I stay the entire day and trade throughout the day. For $95 a month, that's less than 2 ES points. It's the best value going. I cover both NQ and ES. I spend 30 minutes setting the market up beforehand, and I push the NQ and ES charts 99% of the time in the evening prior to 10 p.m. Central Time, so that people have plenty of time to study the chart and get ready for the next day. So I think if you can find a better value out there from someone who has more than 20 years experience, you should take it. I haven't designed this to make a lot of money off of it. I've designed it to help as many people as I possibly can. So if you'd like a trial to that, tradeandperform@gmail.com, and I would love to chat with you sometime soon if you'd like to join the room and come see what it's like. So there's no obligation there. Anyways, I hope everyone's having a great weekend. It's beautiful outside, and I am going to go for a bike ride, I think. So have a great weekend, guys. See y'all on Monday.